This is a story about a dude named Lane. He moved to the mainland and bought one place to stay. And then one day he went, tried to rent them out. And then he became one real investor man.
Hey guys, this is Lane with the Simple Passive Cash Flow Podcast, helping you build wealth with real estate so you can reclaim your life from corporate America or do whatever you like. On today's podcast, I'm going to talk a little bit about my Seattle rentals and why I sold them. Now, I thought that Seattle was a hot market, and it is with all the tech money coming in and the double-digit appreciation in the last few years. But there are a lot of metrics that investors need to know about, such as NOI, ROI, IRR, just to name a few. After purchasing a couple of rentals in the Seattle market and being the beneficiary of some nice appreciation, I evaluate the property's performance with an ROE, or return on equity metric. On one of these Seattle rentals, I had about $250,000 of lazy equity in it. It appreciated all the way up to $450,000, and I had paid approximately $350,000 to begin with. If your kids are at home, get your calculators out. So that $250,000 of equity goes in the denominator of the equation. The numerator is the annual cash flow, which was about $4,000 a year. Therefore, my return on equity was about 2%. So you take the $4,000 divided by $250,000. Frankly, 2% is pretty poor compared to stocks, which I consider around 8 to 10%, or property leverage real estate, which typically returns 20 to even 40%. If you want to see a video of this property, go to Simple Passive Cash Flow and check out the cool GoPro video I made. Yep, there's some more ukulele music I made in there. I hear the phrase from other investors that they're happy with the cash flow that their investment property is making. This is a huge fallacy. You need to look at it from a point of view of how much is my equity gaining? What is my return on equity? Long story short, I decided to sell these rentals to unleash this lazy money and to get it working again with prudent leverage. This is what separates sophisticated investors who look at the numbers and your mom and pop investors who just go by the warm and fuzzy feelings of, hey, I'm making cash flow, life is good. Yes, Mom, you're cash flowing, but that is because you're halfway to 100% cash in a deal, and you're taking on all the hassle and risk for a microscopic return. I want to caveat this argument with just make sure you check out what the numbers are telling you. Make your spreadsheet and figure out what your returns on equities are giving you if you would stay in the current property or if you were to re-leverage into new properties. As I always say, do the math yourself and think for yourself because no one else is going to know your situation better than you are. You got an action plan here to leave you guys, and that is to arrange all your properties on a spreadsheet and calculate their ROE, cash return, and other metrics. Try and look for the lazy money in the group and try and see what your return on equity would be if you were to unleash this lazy money. And that's all there is today, guys. Please review the podcast and leave something nice. Remember that this is not a corporation here making this podcast. It's just one guy talking about his rentals.
This website offers very general information concerning real estate for investment purposes. Every investor situation is unique. Always seek the services of licensed third-party appraisers and inspectors to verify the value and condition of any property you intend to purchase. Use the services of professional title and escrow companies and licensed tax, investment, and or legal advisor before relying on any information contained herein. Information is not guaranteed, as in every investment there is risk. The content found here is just my opinion, and things change, and I reserve the right to change my mind. Above all else, do your own analysis and think for yourself, because in the end, you are the only person who is going to look out for your best interests.